Topic 1. A sharp geopolitical flare-up centered on Iran. A senior Iranian security figure named Ali Larijani and his son and aides was reported killed in an Israeli strike, after which the IRGC announced large-scale missile and drone attacks against Israeli and U.S. assets in the region, striking central Israel, including near Tel Aviv, with reported casualties. Iran claimed attacks on over 100 Israeli military and security targets and strikes near the U.S. embassy in Baghdad and a UAE base. Allied proxy leaders were also reported killed, and Iran's cyber and physical strikes hit banks, SEPA, Meli, and digital security centers. Energy and transport infrastructure, refineries, storage, oil and gas fields, e.g. UAE's Shah field, and ports such as Fujairah, suffered damage, disrupting shipments through the Strait of Hormuz, sending Brent toward $100 and causing broad commodity and shipping volatility. The U.S. responded with measures including a 60-day Jones Act waiver to ease domestic fuel flows and limited strikes. France offered conditional help while Europe stayed cautious, and analysts warn of messy escalation risk, possible wider proxy mobilization, and prolonged pressure on energy finance and shipping. Topic 2. Diesel and gasoline spike feeding inflationary pressure and Fed caution. Maritime supply disruptions from the Middle East shock sent global oil sharply higher and U.S. pump prices up. Diesel topped $5 per gallon from about $3.76 pre-shock, and gasoline rose to roughly 3.9, about a 27-28% jump versus before the conflict. Crude traded broadly between 90 to 108 a barrel. The Federal Reserve faces renewed inflation upside versus slowing growth and employment risks. February PPI rose 3.4% year over year, and February payrolls weakened, pushing policymakers toward holding rates longer and delaying expected rate cuts into late year. Policy rate likely to remain around 3.5 to 3.75% for now. Treasury and strategic oil releases provide limited short-term relief. Tariff and political uncertainties cloud inflation outlook, and Fed succession and political pressures add uncertainty to timing and scale of future easing. Topic 3. Markets roiled: hedge funds, commodities, shipping, and rates. Geopolitical shockwaves destabilized markets. Sharp oil moves and shipping disruptions hit commodity and logistics chains, while inflation fears and growth concerns collided, prompting large repricing across asset classes. Hedge funds reported heavy losses across long, short, global macro, and CTA strategies. Some managers called recent drawdowns among the worst since major events, while shipping and commodity equities saw extreme moves, exemplified by Mitsui OSK surging after activist Elliott disclosed a large stake. Interest rate expectations shifted. Stronger inflation prints lifted Treasury yields. 2-year and 10-year yields rose materially. Traders pushed back on near-term Fed cuts and now see rate reductions more likely in the September-December window, reflecting markets' reassessment of the Fed's higher-for-longer posture. Topic 4. Trump's 60-day suspension of the Jones Act to boost oil flow. President Trump temporarily waived the Jones Act for 60 days to allow foreign flag vessels to carry fuels and other commodities between U.S. ports, aiming to ease gasoline, diesel, and energy logistics disrupted by Strait of Hormuz tensions. The Jones Act normally requires domestic coastwise shipments to use U.S.-built, owned, and crewed vessels, 75% of crew U.S. citizens, so the waiver adds short-term shipping flexibility, but is limited because fewer than 100 compliant tanker vessels exist, and refinery configurations may limit the impact. U.S. maritime groups demanded transparency and safeguards to prevent misuse, warned the waiver would do little to lower pump prices nationally, estimates often below a cent per gallon, and critics noted worker and domestic industry protection concerns. The move echoes past disaster waivers, but faces questions about practical effectiveness. Topic 5. U.S. eases Venezuela oil sanctions to bow.